Boy, are there a lot of scary headlines around at the moment. I'm sure I don't have to tell you that. Open up any social media platform, open up the news, the newspapers, and they're going to come bombarding at you. The coronavirus, a recession in Australia, the stock market crash. It's been a long time since I've seen as many scary headlines as this, and it makes even an optimistic person like me a little bit nervous at times. So in today's episode of the Michael Yardney podcast, I want to bring some perspective to this by explaining some of my thoughts and then having a chat with Dr. Andrew Wilson, who similarly has been around for a long, long time. We've both been in the property arena for well over 40 years and have experienced these things before. No, not the coronavirus we haven't experienced, and we really don't know what's going to happen, but we're going to give you some ideas of what could happen and what you should do, so that at the end of today's show, I hope you're not going to be as scared, but you'll have some facts to work on. By the way, have you noticed most of the things we worry about actually never happen? So we either worry about things that have already happened in the past or things that we're scared are going to happen, and in the general, they don't. And just think back a year ago, all the scary headlines that was telling us what was going to happen to our property markets. None of that happened. Now, I always mention that every year there's an X factor, a black swan event that comes out of the blue. This year we've had a couple already, the bushfires, the Middle Eastern tensions, the coronavirus. So let's have a chat today about what this could mean to you if you're in business, if you're in property, the value of your home. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
What's ahead for our property markets in 2020? Well, probably something very different to what you expected at the beginning of the year, in light of all the things that have been unfolding, including the coronavirus. And that's what we're going to be discussing in today's show. I'm going to give you some thoughts about the underlying fundamentals of our property market. And then in the second half of this show, I'm going to have a chat with Dr. Andrew Wilson, and we'll give you his thoughts as well. But I know that a lot of people are wondering, the stock market's crashed. Is Australia going to go into recession? Is the property market going to crash? What's it mean to the value of my house? Maybe I shouldn't sell at the moment. Maybe I should buy. Maybe I shouldn't buy at the moment and wait for property values to drop further. Well, even though there's a pandemic or an epidemic of medical proportions, there's also something else going on at the moment. There's an infodemic where the media, including social media, is scaring us. It's panicking us. It's making us do things we wouldn't normally do, irrational things like buy bulk toilet paper, buy bottled water. Why? The virus doesn't live in water. And avoid Chinese restaurants and Vietnamese restaurants in the main streets of our suburban towns. So I think over the next little while, I'm not wanting to downplay the medical issues, but I think the biggest thing that's going to happen is businesses are going to suffer, particularly those in hospitality, tourism, education, those who've got supply chain issues, partly because of the slashing of business and consumer confidence. Now, clearly, many Australians are going to come in contact with the virus in the next couple of months. Some people will suffer cold and flu symptoms, and others, more frail members of our society, our community, are going to succumb to the germ. Now, that's tragic. I've been around for a long, long time, and I've seen the Asian bird flu in 2015. I've seen swine flu in 2009-10. I saw the global financial crisis come and go in 2008, 2009. I saw how the SARS virus affected us in 2002-3. I was around when September 11th in 2001 scared the world. I could go on and on. But this time round, it's the major big event like this in the time of social media, which is creating more of a scare in us. So back to my original question, what will this do to our property markets? And of course, I don't really know. But based on my perspective of being involved in property for over 47 years, While this issue will affect our economy and it will have a short-term impact on our property markets, because as I said, consumers are going to become less confident, some are going to sit on the sidelines waiting for things to become clear, I believe a year from now, and particularly in 5 years from now, and definitely in 10 years from now, this pandemic will have no influence on where Australian property values are going to end up and the value of your home or my home. Now, don't get me wrong, I see some potentially serious short-term economic issues, but the underlying fundamentals supporting Australian property markets haven't changed. Now, in a moment, I'm going to have a chat with Dr. Andrew Wilson, Australia's leading housing economist, and he's got a slightly different view on what's ahead for our property markets, and I'm quite happy. We don't always have to agree with each other. But as always, I don't make 30-year investment decisions, and that's what your investment should be long-term, based on the last 30 minutes of news or so. So it's quite likely, in my mind, that Australia's economy will fall into a technical recession. There'll be 2 quarters, maybe the first and second quarter of this financial year, this calendar year, with negative GDP. Now, the time I was recording this, there has been the announcement that there's going to be health measures and there's going to be stimulus from the government. So there are too many unknowns. But most likely there is going to be a recovery in the second half of this year, and it's more than likely our downturn will be short-term. But it will be a disruption to our economy. It'll be a disruption to economic growth, but not like the disruption we had with the last recession, if there is a recession. Of course, jobs growth will go down a bit, our unemployment figures will go up a bit. So it really will depend upon the effectiveness of the stimulus package that the government is going to give us. But unemployment may rise to around 6%. Nothing like the terrible figures that were around in the last recession. Oh, by the way, for those who weren't around 30 years ago or in property 30 years ago when we did have the last recession, and I was, and I remember it, around Australia, other than in Melbourne, property values didn't drop. The Victorian economy suffered the most in the last recession. Unemployment went up to about 11%. Big institutions went down. Big businesses went down. So yes, the Victorian property market suffered then, but the rest of Australia didn't. So just because we do have a recession, a technical term, doesn't mean that people are going to lose their houses. In fact, the bank doesn't want to take over your house. So, as I said, there's too many unknowns. But what isn't unknown is the fundamentals that are supporting our property markets. And that's what I want to chat with you about before I have a chat with Andrew Wilson, because during that chat, and I've already recorded it so I know what he's going to say, he mentions how our fundamentals are pretty strong. But before I go on to that, just to quickly remind you, Warren Buffett clearly said, be fearful when others are greedy and be greedy when others are fearful. So currently, when there's 8 or 10 parties bidding at auctions, if some people suddenly become a bit nervous for a while, my suggestion would be take advantage of the opportunity that others are being a little bit cautious. Because again, don't make long-term decisions based on short-term opportunity. The market's going strongly at the moment, especially in Melbourne, Sydney and Brisbane. I just came back from our Brisbane office where one of our buyer's agents went to an auction and there were 30 bidders. Now, not that way at every auction, but at good properties there are. She would have been happy that half of them decided to stay home and not catch the coronavirus with people coughing. Now, again, I'm not belittling the nasty end results if you get the potential end results if you get the illness. What I'm saying, though, is if there is a slump in consumer confidence, it'll be short-term, so take advantage of it. Remember, Warren Buffett said, be fearful when others are greedy and be greedy when others are fearful. So home buyers and long-term investors who've got a secure job, who've got secure income, who've got pre-approved finance should take advantage of any short-term downturn in their property markets to set themselves up for the next phase of the property cycle. But as I said, I'm comfortable with the fundamentals supporting our property markets in the medium to long term. So let's have a quick look at them. First of all, you've heard it before, but let me remind you, Australia's population growth is one of the things that's underpinning our property markets. Actually, it's more household formation. So we're growing at 360,000 people a year, meaning we need to build 170, 180,000 new dwellings each year to accommodate all the new households. In the meantime, though, we're not making as many of these new dwellings that are required. The oversupply of dwellings that occurred in many Australian locations now dwindling. There are very few new large projects on the drawing board, very few cranes in the sky anymore. So considering how long it takes to build the new estates or the large apartment complexes, we're going to experience an undersupply of well-located properties in our capital cities in the next year or two. So the supply and demand ratio is going to underpin our property markets. More demand, population growth, less supply. The other thing is interest rates are low and they're going to fall further. The prevailing low interest environment is really making it much easier to own a home, either as an owner-occupier or as an investor, than it ever has been. It's never been cheaper. Your net outlay as an investor, your out-of-pocket expenses, is the lowest it's been for decades, considering how cheap finance is today. So more people are going to get into the market, including first home buyers. First home buyers are back. They're back with a vengeance, in part thanks to the government's new scheme to encourage them, but also because of the cheap finance and also because of rising property prices. As opposed to established home buyers who've got a trade-in that's increasing in value, if first home buyers wait to get into the market that's moving so fast, they're often finding that they can't save a deposit as fast as the market's moving. So they're hoping to hop on board the property trade as quickly as they can. So again, increasing demand at a time of decreasing supply. Also, we're having smaller households. Sure, many people are living in multi-generational homes, but pretty soon millennials are going to make up a third of our property market, and their households, in general, tend to be smaller, as do the households of that other big growing population age group, the 65 plus demographics. The 65-year-old plus demographics, I guess I should say. Putting all this together means more 1 and 2 people households means that, moving forward, we're going to need more dwellings just for the same number of people because there are fewer people living in them. Another trend, another fundamental that's underpinning our property markets are that soon 40% of our population are likely to be renters, partly due to affordability issues and a lot of it due to lifestyle changes. The government isn't providing accommodation for these people anymore. They're leaving it up to you and me as property investors to do that. So property investors are going to remain in the market. And in general, the underlying fundamentals of our economy, long term, not the short term, are strong. Sure, our economy is facing challenges and sure, the share market's volatile, but our property markets are underpinned by the fact that 70% of property owners are homeowners. Homeowners who are there for the long term. They're not going to sell up their homes. They'd rather eat dog food than give up their homes. So Australia's housing population, homeowner population, our culture of that is underpinning the property markets. In fact, it's the only investment market not dominated by investors. In other words, 7 million homeowners are protecting the value of your assets. At the same time, Australia's banking system is strong, is stable, is sound. Yeah, I know some people have overcommitted themselves. Some are first home buyers wanting to get in the market. Others are investors who borrowed too much and bought in wrong locations. But in general, there should be no real concerns about household debt because in general, it's in the hands of those who can afford it. There's currently a very low rate of mortgage defaults of mortgages, and it's not increasing much at all. But as the community starts to become more concerned about the economic impact of the coronavirus, it's likely that there's going to be a flight to quality assets. Again, every time people are interested in getting the stock market, they see how volatile it is, they get scared. Where are they going to put their money? They're not going to put it on cash in the bank or deposits, so brick and mortar will remain a sound asset that's stood the test of time. So the bottom line is our property markets are firm. They're underpinned by good fundamentals. We will have a bit of a shakeout. We are going to have a bit of a more difficult time. And we're going to chat with Andrew Wilson in just a moment about that. But like other worldwide epidemics, this too shall pass. We will move on, and it shouldn't change your long-term plans as long as you've got a sound income, a solid job, and you've got a long-term perspective with the finance structures in place to buy you time. Because smart property investors don't only buy properties, but they have cash flow buffers to ride the ups and downs of the property market. Now, with that introduction, in a moment, after my mindset message, we're going to have a talk with Andrew Wilson and get his views on what the coronavirus means.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
I write a lot about money and property in my blogs. I discuss it in my podcasts, but when you get to know me, you'll realise that I believe true wealth is what you're left with when they take away all your money. Sure, money's important in some aspects of your life, but it's not important in others, is it? So in today's Mindset Moment, I'd like to share with you a list of things that you'll regret in the future if you don't do them now. It's a way of me emphasising the point that money is important in those areas where it's important and not at all important in other areas of your life. So number one, put your health and wellness above everything else. There's an old saying, if you don't have your health, you have nothing. I think that's true. Number two, take the time to do the things that you love. Now this may sound cliche, but work less and play more. You'll never regret taking a vacation, engaging in a new hobby, or spending a day with those who make you happy. The third thing I'd like to remind you is to stop taking life so seriously. Why are you taking it so seriously anyway? When you think about it, most of the things you worried about in the past never really occurred, did they? The fourth thing I'd like to share with you is always say what you need to say. If you love somebody, tell them. If somebody hurt you, tell them. If you've got trouble expressing your feelings, write a letter, do an email. Make sure that those around you know each and every day how you feel. The fifth lesson is open up your mind to possibilities. If you have a closed mind, if you stay in your comfort zone, you'll never get to the next level. You'll never truly enjoy life. The sixth lesson I'd like to share is follow your own path, live a true life, one that's true to you. Stop comparing yourself to other people and stop trying to be a perfectionist. Stop living a life based on the expectation of others or what you think others are achieving. Because when you look at Facebook and you look at Instagram, you're seeing their highlight reel. You're not seeing all the bits on the cutting room floor. Another lesson to know is stop living in the past. Right now, you need to throw away the regrets from the past. It's gone. There's no point dwelling on what could have been. Doing so is only going to rob you of the joy of what's happening at the moment. The past doesn't exist other than a memory. It's a mental story, and it can't be changed, so move on. I guess that brings me to the next lesson. Accept the things you can't change. Lesson 9 I'd like to share with you to show you that there are 12 things at least that are more important than money is practice mindful living. Mindful living will slow down time. It will enhance the present moment. It'll fill what could have otherwise been mundane days with awe and with joy. Appreciate what you've got. Be grateful for what you've got. The 10th lesson is stop chasing money, fame and possession. I know we crave wealth, prestige, fame and popularity. We crave material things, beautiful people, the next big toy, the shiny object. We mistakenly think that happiness is going to arrive when we meet these goals. Instead of enjoying our life, we seem to be in constant pursuit of something other than what we've already got, what we've got right now. At the end of your life, your expensive BMW, that's not what's going to be flashing through your mind. You're more likely going to be remembering about the memory of a loyal dog or a loved one. So stop chasing material possessions. There's no real happiness there, only an endless pursuit. And another lesson I'd like to mention to you is always practice gratitude. I've already said it briefly before, but you'll never ever be wealthy if you're not grateful for what we've got. And you live in the best country in the world, the best time in history. Enjoy it, appreciate it. And the last thing that's more important than money is love. Pay attention to all the sources of love in your life and you'll develop a growing sense of abundance of how much beauty surrounds you each day. So, remember, there are many things in this life more important than money. In a moment, I'm going to have a chat with Dr. Andrew Wilson about his views regarding the coronavirus, a recession coming, and the property markets. Well, you know, once a week we have our Property Insiders video recording, so this is an audio of that recording. But Andrew has got some slightly different views to me. I think you're going to find them interesting, insightful as always, opinionated as always. Hey, But that's part of the fun of my chats with Andrew Wilson. Before I do that, though, I just want to remind you that once a year I get together with a small group of already successful Australian business people, entrepreneurs and investors at Wealth Retreat, which is Australia's leading event where we discuss tax, property, finance, business, the share market. Once a year for 5 days, we get together with a small group of very successful people, business owners, entrepreneurs and investors, and we plan their future. Now, you may wonder, if they're already successful, why do they bother going? Because they want to get to the next level. By the way, don't count yourself out. It's an invitation-only event, so if you go to wealthretreat.com.au, and there'll be a link in the show notes, and express your interest, have a look at all the information on the page, look at some of the testimonials from other people and the attendees' benefits that they got from it, and then have a chat with me, because every attendee has a one-on-one chat with me, because I want to make sure it works for you, because I'm going to guarantee your attendance there. My aim is to help you plan the next 5 years of your life. That's what the theme of Wealth Retreat is, and it's to actually not just give you wealth now, but to create lifetime wealth, intergenerational wealth. You've heard about it before. This is the year you've got to come. Join us on the Gold Coast, June 6th to 10th. Go to wealthretreat.com.au. Leave your details. I look forward to having a chat with you. Clearly, 2020 isn't going to be the year many of us expected it to be. Droughts, bushfires, and now there's the coronavirus. So what's ahead for our property markets, particularly in light of the coronavirus issues? Are the property markets going to crash like the share market has? Is Australia going to fall into recession? Now, clearly that's on the mind of many investors in light of the economic woes around the world and the uncertainty surrounding the coronavirus. So to discuss these important questions, let's have a chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of myhousingmarket.com.au. Hello, Andrew.
Hello, Michael. Yes, I'm glad to see you still smiling.
It's hard when you turn on the news or look at your iPad. There's so much bad news there, isn't there?
Yeah, I guess one doesn't want to be cynical about this, but certainly it's been a year so far, as you alluded to, of quite scary headlines, and not wishing to downplay anything, we certainly now have the scariest of all our headlines in regard to the coronavirus. But as we speak, or a glimmer of hope on the horizon in terms of, a lot of the doubt, which of course we can understand, is starting to now crystallise into a little bit more certainty as to the outlook. But there's no doubt that this has had a significant impact on global markets, particularly share market.
Well, let's make it clear so there's no confusion. You're not a medical doctor, are you? You're actually a doctor, a real doctor, a PhD.
Well, that's perhaps one way of putting it. But a PhD really is a person whose primary qualification is in research.
Sure. Well, at the moment, there's not warning that this is a pandemic. But before we had a chat, I actually had a quick look, and the definition of pandemic suggests that actually we have got a pandemic, even though our health authorities aren't going to call it that. But let's maybe call it something different. It's an infodemic. There's so much information in the media, scary social media, panicking people into buying toilet paper, bottled water, and even in the Chinese restaurants, people aren't going to the Chinese restaurants in suburban Australia. So back to my original question, Andrew. What's going to happen? Because I see two extreme views. Some say it's just going to be a bad flu, nothing to fuss about, while others think it's going to trigger a major humanitarian and economic catastrophe, killing millions of people and triggering a global recession. What are your thoughts?
Well, I think that as the evidence is unfolding, Michael, this is quite similar so far to seasonal influenza in terms of its effects on those that are infected by it. We're now starting to see evidence again of those significant majority of those that are infected are recovering. And we're also seeing in those countries where there was the initial, surge in the coronavirus, and that's China and South Korea, that there's now a significant decline in new infections. So it seems to be working its way through particular populations. But as you've said, Michael, we're in the era of mass communication and globalisation, and that's affected particularly economies in the short term, but I'm not so sure in the medium term. It certainly had us glued to our television sets and our media outlets. I'm not sure that they've shrouded themselves in credibility in terms of the scaremongering in some parts of the media that, not surprisingly, has been a feature.
Well, we've both been in property for a long time. I've been investing for over 47 years. And looking back on my perspective gives me an opportunity to see what it's going to look like maybe in the medium to long term. There's no doubt that the uncertainty in the short term is still working its way through. We don't know at the time of this recording how big the government incentive packages are, but it looks like the government's going to step in quickly. Federal governments, state governments are doing things. But Andrew, I believe a year from now, definitely 5 years from now, and certainly 10 years from now, this pandemic will have had no influence on where the Australian property markets are going to end up or the value of your and my home. Sure, in the short term, they may have some effects.
I'm a little bit more optimistic than you, Michael. I don't think they'll have any effect at all. Certainly not a noticeable effect. And I think the housing market is a completely different animal to the share market. We don't have that hysterical volatility either up or down, and we're not as exposed as our local share market is to what happens particularly on Wall Street. Just as a bit of an update, probably seeing some early signs of marginal impact on the housing market. Michael, I do track new listings coming through on a daily basis, properties advertised for sale. And at the beginning of this week, and of course this is the second week in March, just started to see a falling off of new listings, just down by a couple of percent on a week-by-week basis. Now, there might be some seasonality involved in that because new listings project towards weeks ahead of market activity, particularly for auctions, and we have Easter coming up. So that might be a reflection of some easing in new listings for the Easter period. But nonetheless, there is a slight sign there that listings are just tapering off marginally, and that may be due to sellers just feeling that they're going to wait and see how this particular issue pans out. But until this date, auction clearance rates really haven't missed a beat, very strong in Sydney, and buyers are still up and about in that sense. But I can understand if some sellers were just becoming a little bit hesitant, those discretionary sellers, about putting their property on the market.
Well, discretionary sellers are wondering what's in store if I could put it in the market, what's the auction market going to be like in 4 weeks' time? And buyers are maybe wondering, can I get it a bit cheaper? They're reading that the stock market has crashed. So let's just quickly put that in perspective, because over the 40-odd years I've been investing, I looked it up, there have been 12 corrections in the stock market of 10% or more. There have been 8 corrections in the stock market of 20% or more. We've had 5 recessions where we've had 2 quarters of negative growth in the past 40 years. We've had significant drops in the stock market that recently have just taken us back to the levels of 2019. But look at property over the last 40 years, Andrew. Those same 40 years, when it started in 1980, the median price in Melbourne was $39,000. Today it's closer to $900,000. The median price in Sydney 40 years ago was $68,000. Now it's over $1 million. Property is much more resilient, much more stable, and I guess it's because it's underpinned by owner-occupiers who are not going to sell up if suddenly the coronavirus comes.
Well, why would you? I mean, a property is based on the provision of a good that we all need, and that's shelter, of course. Whereas, stock market has that volatility. Our share market is affected by Wall Street in terms of its ups and downs. Now, if we look at the performance, as you mentioned, of property versus the share market, we can see now with this shakeout through the coronavirus, the All Ords is back to where it was around about at its post-GFC peak. Now, since that period, we've seen the US stock market double in value, and house prices, as you said, in Melbourne and Sydney have doubled in value, and that's since the end of 2007. So notwithstanding its connection to Wall Street, the Australian share market has clearly underperformed since the GFC, particularly versus Wall Street, and obviously particularly versus the growth or prices for houses in Melbourne and Sydney.
Now, we don't want to downplay the effects on some businesses. If you're in the tourism industry, hospitality industry, certain retail sectors, there's no doubt businesses are going to suffer, and there'll be some supply chain issues as well. And some people are suggesting now this could finally lead Australia into a technical recession. In other words, a couple of quarters of negative GDP, negative growth. But it's likely that if that's the case, there's going to be a recovery in the second half of the year. And when you look back at the end of this year, it'll be a blip, it'll be a disruption, but it's not going to be anything like the recessions of 30 years ago, Andrew.
Well, that's right, Michael. And the first point I'd like to make is that we've had, which concerns me, some heroic and certainly, I believe, premature predictions of an almost certain recession over the second half of 2020. That obviously means negative growth in September quarter, followed up by negative growth in the December quarter. Now, our GDP numbers have certainly not been what they were during the mining boom. Our latest quarterly growth rate was just 0.5%. Over the December quarter. So it wouldn't take much, I guess, to trim that 0.5%, given we're likely to take a hit from, as you suggested, tourism, students particularly, which is a significant export sector, and those supply chain issues also. So given that just that 0.5% growth rate over December, I guess it's logical that we would expect to see significant hit on that 0.5%. I'm not so sure, Michael. The government has announced significant stimulus packages in the billions of dollars, designed obviously to offset that. There's been a lot of negativity about our economic growth, our GDP. It hasn't really come to, I guess, reality in terms of those predictions of a recession. I'm not so sure it'll be a reality, as some have almost certainly predicted over the second half of this year. It's likely to be lower, of course, but whether we actually get 2 consecutive quarters of negative economic growth, I think that's still not as likely as we have to have perhaps one at the outside, followed up by a gradual recovery in growth. The governments, not just the Australian government, but all governments, are committed to doing what it takes to offset the negativity of the coronavirus impact.
I think they've done well in regard to health measures, but also economic measures. They've actually taken the front foot, and that's to everyone's advantage. But it's social media, and I guess the media in general, that's scaring people. So what's going to be missing in the next little while, in my mind, Andrew, is business confidence and consumer confidence.
Well, look, that's right, Michael. And I think we've sort of been a little negative about the share market, and it is volatile. That's the nature of the beast. But I think if we can get a sustained recovery in the share market, and early days it's looking like that might be beginning, I think that'll be the first step into recovering confidence. And I think profit takers will have moved out of the market, and those thinking about it being a good time to buy will start to move in, and understanding that really the fundamentals of the economy as they stand now are still quite robust. Although I'm certainly not suggesting we won't have some impacts from the coronavirus, particularly on our export sector, which reflects people traffic, and that's, of course, tourism and students. I'm reasonably positive that that will be offset to some degree by government action.
So a final message to those people who are interested in getting in the property market, whether as a home buyer or as an investor, what would you say to them?
Well, look, I still think the fundamentals are what you look at, Michael, and the fundamentals are that we're still recovering in Melbourne and Sydney, particularly from what was basically a media-fueled downturn and a fear initiative, low confidence a year ago. So there's plenty of upside in terms of recovering, with prices in Sydney and Melbourne still below where they were 3 years ago. And of course, we still have the lowest interest rates on record, and probably another cut likely as part of that government stimulus package and stimulation by the Reserve Bank, which will only make property even more affordable. And we have a surge in first home buyer activity happening at the moment, Michael. So I still think the positives are there for the housing market. Early signs of a flattening of what's been a sharp decline in confidence. And I'm hopeful that we won't have this as a significant issue really within months, rather than the years that some are quite concerningly promoting at the moment.
In my mind, you shouldn't make 30-year investment decisions or 10, 15-year home buying decisions based on the last 30 minutes of news. I remember the wise King Solomon had an inscription in his ring that said, "This too shall pass." That was so he wouldn't be too confident in the good times or too despondent in the bad times. Sure, the coronavirus has spooked our markets around the world, markets in Australia, and there's no doubt it is going to have an economic impact. But like all the other world epidemics we've experienced, this too shall pass. And I know, Andrew, you recently quoted, it was actually Franklin Roosevelt who said in his inaugural speech, "There's nothing to fear but fear itself." They were wise words.
Well, they actually came from Voltaire in the 18th century, Michael, but I don't want to get too deep into the academic side of things. But I think that the other point to this is a very good test for our open market environment and globalisation. I guess some would say that this is a test for globalisation and has perhaps produced some negatives as a result of our open border policy that's really been an ideological tenet for the last 20 or 30 years. But if we get through it, I guess we'll get through it together. And signs are that that's happening now. And maybe that's, again, a positive for the next time we do have another incident such as this, to test our resolve and to test our confidence.
Well, we'll be meeting once a week to have these Property Insider chats. It'll be interesting to see how things unfold. Thanks for your thoughts. Thanks for your time, Andrew.
Yeah, good chat. Thanks, Michael.
Well, a lot of fuss about coronavirus in today's show, but it's the elephant in the room. It's something we've got to talk about, and it's quite likely between the time we recorded this and you listened to it, things have changed again. So it's a moving feast. All my suggestions is not making long-term decisions based on short-term emotional factors. And remember, if you've got a secure job, if you've got some money coming in, it's a good time to take advantage of any short-term downturn. In the meantime, if you got some benefit from this, if it's brought some clarity and you know somebody else who you think would get some benefit from today's show, please tell them about it. Pass it on through social media or just tell somebody about the Michael Yardney podcast. I'm thrilled how our subscriber base, not just in Australia, but around the world, is continuously growing. We've had well over 1 million downloads now. That happened at the beginning of this year. So I look forward to bringing you this show twice a week, but in between, you can catch up with me on social media or daily in my property update blog. Catch up with you again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?